All right, everybody. Hi, this is Sean Briscom, and I want to welcome everyone to the webinar today. We're going to be going over a couple of different topics today. Number one, we're going to be talking about Europe again, obviously, because it's melting down faster than we expected. In fact, I've got an article here. Let me share my screen with you real quickly so that you can see what I'm talking about. But this article came from a client of mine recently, actually just this morning. And what's interesting to me is that, like we always say, sometimes the psychology of events is more important than the actual numbers themselves. We've been running a deficit for a long time now, since the last collapse, the last crash, when our government stepped in and bailed everybody out, bailed out the banks. And it was to the tune of about $4 trillion. I don't know if you remember that number, but number at the time, a trillion has 16 zeros after it. So, just think in terms of what that means, the significance of $1 trillion, 16 zeros. We are now standing at, well, let's take a look. We are at 18 trillion. Let me see. Load this up right here. Okay, we're at 18 trillion 344 billion 259 million in national debt, total national debt. Now, that's just the debt that the government has used to bail out these various programs, these banks, these, sometimes they call it a bailout or sometimes they call it a bail-in, but it's the same. It's just basically money printing and wiping debt clean. They wipe the debt clean from the banks or from the financial institution, and then they recapitalize that institution by printing more money. And so you can see here that if you combine also the household, business debt, state, local governments, municipalities, other financial institutions, credit card debt, car loan debt, student loan debt, everything combined, we're at $61 trillion, okay? That's 132% debt to GDP ratio. GDP is gross domestic product. Think of that as your income, and think of this as your debt. So you're 132% in debt, up over and above what you're making, what your income is. Let me try and phrase that a better way. You're spending 132% more than what you're making, or 32% more than what you're making, sorry. So debt to GDP ratio is 132%. Why do I bring that up? Why is that a key concept for me? Well, because we know from basic economics that once you pass 70% debt to GDP ratio, you are literally insolvent. That is the definition of being insolvent. When 70% or more of your income is going out in the form of debt, you're insolvent as a nation, as an entity, even in your own personal economy. And so we're at 132%. And so here's what's happening. The European crisis, the meltdown in Europe, has gotten everyone from Putin to ordinary savers stockpiling gold. All right, now why would they stockpile gold? Why is gold considered a good position to hold your wealth in, or precious metals in general? Well, it's because it has intrinsic value. It always has, and it always will. Just the fact that it takes work to get it out of the ground, takes a lot of labor, a lot of time, energy, money, and work to get it out of the ground, creates that value. Okay, how much value is in currency that can be literally printed or typed into a keyboard on a computer somewhere in a bank. How much value does that have in comparison? Okay. Now, I'm going to shock you. Got a phone call from a friend of mine who's a hedge fund manager. A lot of you know him. And he manages a $28 billion endowment fund at the University of Texas here in Austin. And he put about $1 billion worth of that endowment fund into gold bars, just like you see here. There were, I believe, 1,600 gold bars. And so he put $1 billion worth of that fund into gold. And they wanted to take physical possession of it. So they took physical possession of it. They created a underground bunker or storage facility under the university. And that gold has been moved from New York to Austin, Texas, and is now being warehoused in that facility. Okay. So recently he told me that, you know, the gold came from the COMEX, which is the Chicago Mercantile Exchange. It's the CME, where all kinds of commodities are traded. You know, they trade oil and gas, they trade pork bellies, they trade, you know, precious metals, they trade grain, they trade any kind of commodity you can think of on the COMEX, okay? Now, while they're trading, when you think about trading, it's really just an electronic transaction between computers, right? That order. Well, where's the actual physical item? If someone buys a barrel of oil, for example, what are they really buying on the COMEX? Are they taking delivery of that barrel of oil? No. What they're doing is they're just taking a certificate, a piece of paper that says that they own that barrel of oil, that they've purchased that barrel of oil. And they may sell that if it appreciates in price, or they may use that for their own purposes if they want to take delivery of it. But most traders just hold the paper. They don't hold the physical object. The physical object is actually held in a warehouse in Chicago. It's supposed to be held in a warehouse in Chicago, I should say. Well, when Kyle went and bought $1 billion worth of gold for the University of Texas and went to that warehouse, first thing he noticed is that there was no gold on the shelves anywhere to be found. And so he asked the manager on duty how much gold is physically on hand in the warehouse. And at the time, there were only $2.3 billion worth of physical gold on hand. And Kyle was taking $1 billion of that with him. Well, the reason I bring that up is that today there are only $387 million worth of gold in the warehouse. Let me say that again. Today, there's only $387 million worth of physical gold in the warehouse today. And the amount of paper being traded on the COMEX digitally is $86 billion in gold. So $86 billion worth of gold is being traded on a daily basis. But in reality, in the warehouse, there's only $387 million worth of gold, which is not a lot. Okay. So what's happening is there's going to be a run on metals very soon. And so if you don't have any metals in your portfolio, physical metals, you need to get in touch with us very quickly, because crises like these that are happening over in Europe tend to happen exponentially fast as we go on down the road. So you know, things kind of build to a point to where, you know, the government just can't control it anymore, and it breaks free, and there's a run on the banks and everybody tries to get their cash out of the banks, for example. Or there's a run on gold house and there's no more physical gold anywhere. So when that happens, and you see that the spot price of gold is $1,000 or $1,100 an ounce, but there is no physical gold to be found, to be purchased, how much do you think you'll be able to sell your gold for or your silver for at that time? You know, I'll give you a perfect example, another story. I do deal in gold and silver on our platform, on our website, which let me show you that website here. This is our coaching platform. It's called the Strategic Wealth Network. Whoop. Sorry about that. And it's broken down into three different sections. It begins with your what we call your foundation, or your you know, where you're going to warehouse your capital, essentially. Whether or not you're looking for an opportunity, or if you're just to protect your money and protect those dollars that you have in your possession, in your personal economy, you've got to understand where to put that money, where to stash that cash. So that's what we teach you how to do in step one. In step two, we show you how to generate real returns by unlocking your qualified accounts. And so if you go to that section, you'll find that there's a great video here on creating your own self-managed IRA or qualified account, or getting your qualified account out of the hands of the custodian who's actually managing that account and charging you fees, fee after fee after fee every single year, whether or not you're making money or losing money, right? Well, we show you how to jailbreak that qualified account in this video, and we have the form here that you can actually fill out and send back into us, and we have our attorneys jailbreak it for you. There's a small filing fee because you have to create an LLC to do it, but other than that, what you're doing essentially is you're getting it out of the market, out of the volatility of the market, and out of the myth that is the stock market, because there is nothing really being traded on the stock market anymore. You know, we don't even the dollars, the paper dollars, you know, are fake. They're not real. You know, these numbers that you see here, look at this. Student loan debt has risen to $1.3 trillion in student loan debt. How are we going to pay that off? Every single person in the country owes $52,623 right now, today. So if you don't have your $52,000 ready to go to pay back, then that means we're not going to pay back any of this debt that we have. Personal debt, consumption debt is at $16.9 trillion. Mortgage debt is at $13.4 trillion. Credit card debt, $904 billion. That's insane. $904 billion in credit card debt. So anyway, we show you how to jailbreak that qualified account, get that money out of the market where it's not safe, where it's not liquid, where you're not going to be able to get your hands on it. And we also show you how to purchase precious metals as a hedge. And so I go through that scenario on how to do that. And then I also show people where you can go to actually purchase metals. We've created this website called SWN Metals, stands for the Strategic Wealth Network Metals Company, and company here, and you can buy metals at cost. Okay, so this is what I love about this, is that the spot price right now today of gold is at $1,115 an ounce. That's for the lump metal. A 1 ounce gold eagle that we sell sells for $1,152 an ounce. So we're essentially selling this coin at cost. The markup, that $50 markup from the spot price, actually $40 markup, not even $40 markup, that comes from the mint. The mint marks it up to $1,152. This is our cost. This is what it costs us to buy this gold coin and that's exactly what it costs you if you join as a member. Okay. We also sell silver, so you can buy silver by the box, where there are 500 ounces per box, or you can buy it individually. You can buy Canadian Maple Leafs. You can buy Austrian Philharmonic silver dollars. You can buy generic rounds, which are slightly cheaper. All right, now look at this. You can see that the spot price of silver, the lump silver, is $15.43. As soon as they strike that coin and turn it into a currency or an actual item of value, they bump the price up slightly. So we sell it for $18.18. The spot price or lump silver is selling for $15.43. So it's about $2.50 over spot, roughly, is what the mint charges. And that's exactly what you pay when you're a member of our site. Okay. Sorry, getting off on a tangent here. But the point that I'm trying to make here is that the psychology of human behavior is more critical today than ever before, because at a certain point in time, when the herd or the masses shift gears and they stop, they literally stop listening to the government or stop believing what the government is telling them, then they're off to the races and they're doing their own thing. And it looks like right now everybody's buying gold and silver, buying precious metals. So suggestion, buy some precious metals. Get on our website, sign up at swnmetals.com, and join our membership club. This company that we've created is kind of like a Sam's Club model, where you have the ability to join and get everything at cost. So you pay a membership fee, and then you can buy all the bullion you want at cost. We're also going to be adding jewelry and some other items. We also do numismatic coins as well. So you can buy numismatic coins, you can buy silver, just minted silver, you can buy minted gold. It's totally up to you. But anyway, that's what I wanted to show you right now is what's going on over in Europe. And so do me a favor, feel free to chat and use the chat function. If you have any questions or anything, if something's not clear, then let me know. And we can answer those questions as we go. But there's something else that I wanted to address. So if you're not going to store your wealth in the banking system, for example, then where do you store it? Where do you actually store that wealth? You know, where do you stash your cash, so to speak? That's the key concept. And so what we're going to do is we're going to kind of open up the kimono here, and I'm going to show you exactly what criteria we use for stashing our cash, and where we actually protect and insulate and warehouse our capital while we're either waiting for a deal to come up or just protecting our own interests. Okay, so let me show you this. We call it the reserve capital strategy, and that this is a unique strategy that we use with all of our clients to warehouse their capital and store their cash while they're waiting to deploy that capital into a deal, into a income producing deal, or even buying gold and silver with it. And so what are the characteristics of that private, private reserve account, essentially, is what we call it. What does it need to look like? What does that account need to look like? Well, the first thing we would hope for is tax deferred growth. So most people believe right now today, they believe that 401ks and IRAs and mutual funds and the like are the safest place to build wealth because it's tax deferred growth, right? The second thing we want to do is to have access to our money on a tax-free basis when we distribute that cash. So as you're taking distributions, we want those to be tax-free as well. We want competitive rates of return. So if you think about the market in your 401k, what is your rate of return on your 401k? And is it consistent? Is it an uninterrupted rate of return, or does it fluctuate? Is there volatility in the market, or is it consistent rates of return? Okay, that's something else we look at. We want to be able to put as much money into this account as we want to. Okay, so high contributions are important to us. Deductible contributions, if we contribute to this account, can we deduct that from our taxes? Collateral opportunities. Collateral opportunities simply means, can I use this account and collateralize it like I collateralize my house and borrow against it? Okay. Let's see. Sorry about that. So collateral opportunities is important. We also want to have a safe harbor. We want to make sure that it's lawsuit proof, judgment proof, and creditor proof. We want to make sure that nobody can touch the money in this account, in our capital, in our private reserve or our reserve capital account. Okay. We also want no loss provisions. We don't want to lose any money. We want guaranteed loans against that account. We want to be able to collateralize that account and borrow against it. So that's important to us as well. We also want to be able to repay those loans at our own pace. We want to dictate the terms and the rates of those loan repayments. Okay. We also want liquidity and use and control of the money and additional benefits. And so there are a ton of accounts that might work as a private reserve or as a reserve capital account. But some work better than others, right? And so we're going to examine some of those account types. The first type of account that we talked about was a 401k, or a qualified account. And that does give us tax-deferred growth, excuse me. It can give us competitive rates of return. We can get very high rates of return, but we can also lose money in that account, right? It does provide additional benefits, meaning we can do loans against a 401k, but we're limited on those loans. The maximum that you can borrow against your 401k is $50,000 or half of the account balance, whichever is lower. Okay. You do have deductible contributions sometimes, depending on who owns the 401k and who's managing it. The other type of account, well, let's go on. So let's examine these loans against a 401k. Loans have to be repaid in less than 5 years, or they're considered a distribution and they're considered taxable. And the account holder is less than 59, and they also have that 10% early withdrawal penalty that you have to pay against that account. Okay, interest on the loan is paid back to your account on an after-tax basis, while latter dividends are taxable. So that results in double taxation on the loan interest itself. Does that make sense? Hope it does. And then a job change can trigger a distribution event, which if you're, or if you're younger than 59 and a half, you're going to have to pay the additional 10% early withdrawal tax. Okay. Another type of account is just a CD. CDs offer high contributions. You can put as much money into them as you want. You can collateral harbor, and it does have no loss provisions. But what are the rates of return on a CD today? What is it, 1%, 2%? Interest rates tend to be relatively low. Interest is taxed at ordinary income tax rates. Any loans must be negotiated with the bank, and there is no guarantee or assurance that the loan will be made against your CD. Think about that for a second. Just because you have money that is being held by the bank does not mean that they will give you a loan against that cash. How crazy is that? And they can also call that loan at any time. And this usually catches people off guard when they do that. So CDs are not the best account to use. Well, what about a margin or a stock portfolio? Margin account on a stock portfolio. Can you borrow against your stock portfolio? Well, you can get competitive rates. There are collateral opportunities. You can borrow against it. There is liquidity, use, and control of the money. But loan rates are usually tied to LIBOR, and they fluctuate. They're not guaranteed. And if a hedge fund shorts something, that could trigger a decline in the underlying security in the stock, and it could cause a margin call, where if your portfolio drops below a certain level, they simply just call the loan due immediately. It's due on demand is what they call it. It's a demand clause. Okay. You can also use real estate with a home equity line. How safe is it? How liquid is it? What is the rate of return on it? And how is it taxed if you don't pay that back? You can do it on a savings account or a money market account. Okay. You can put in as much money as you want. You can collateralize it. It is a safe harbor. There are no loss provisions, and you do have liquidity, use, and control of the account. But what is the rate of return on a money market today? 2%, maybe 2.5%, somewhere around there. The only place that we really warehouse our cash is in permanent life insurance. And it's a unique strategy that we teach our clients. And it's actually a strategy that's been around for ages. You know, the wealthiest families in America all know about this strategy and all use it. In fact, I was actually having a conversation with Brad Hilton at one point in time, and he asked me, you know, what do I do? And I told him, you know, we teach clients this strategy about using life insurance as a family trust, where they have tax-deferred growth, tax-free distribution, competitive returns. They can contribute as much as they want. It has all these collateral opportunities. It's a safe harbor, has no loss provisions, guaranteed loan options, yada, yada, yada. Well, he starts laughing, and I said, well, what's so funny? And he said, well, did you know that that's the exact same thing that we do with our family, with the Hiltons? But the difference is that with the Hiltons, it's cultural. Everybody in the family knows that they never touch the family money. They never, ever, ever touch the family money. So what they do is they go to Uncle Brad, and when they need to buy a car, buy a home, go on vacation, go to school, whatever the case may be, they just simply collateralize the family trust, borrow at preferred rates, use someone else's money to pay for the item, and then all the new income from the business goes right back into the family trust, repaying those loans and adding to the total balance. And I kind of laughed, and I said, that's exactly what we teach our clients to do. And I said, do you mind if I ask, where do you stash your cash? Where do you hold the family trust? And he kind of smiled, and he said, well, we own a life insurance company. So if it's good enough for the Hiltons, it should be good enough for you, is my point. Okay? And so let me switch over real quickly here and get back into what we were discussing originally, which is the run on the banks and the run on gold and silver right now. Okay, you know, the challenge that we have with the media today is that they're not really telling us the whole truth. They're telling us half truths, and so we really don't know where we stand with our banking system here in America. The question I have for you is, do you really believe, does anybody really believe that what's happening in Europe is not going to happen here in the United States. You know, think about that for a second. Can what's happening over there happen here? Well, the answer is yes, absolutely. Obviously, yes, it can. So how do we protect ourselves? What do we do to protect ourselves? Well, what we do is we use a very unique system using life insurance to protect and insulate yourself from the volatility of the marketplace and the changing rules of the game. Let's just put it that way. You know, one of the key challenges is that at any time the government can step in and they can literally say, okay, we're going to change the rules, and you now have to invest half of your 401k in U.S. Treasuries, for example, which is actually what is occurring right now. The government right now is setting up an account called a MYRA. It stands for My IRA. It's MYRA, MYRA account. And 50% of that account must go into U.S. Treasuries. Why are they doing that? Well, the answer is obvious. They're out of money. So they have to tap into your account, your 401k or your IRA. So how do you get it out of their hands? How do you make sure that that doesn't happen? Well, what we do is we simply set up a system that we teach our clients that is called the Reserve Capital Strategy. And let me share my screen again so you can see what I'm looking at here. This graphic that you see right here is actually a depiction of your own personal economy. Okay, you have an income tank here that where all your income flows through, and let me show you here. You either earn income from your job, from other sources, but you know, the amount of money that we earn over our life is finite. You know, we don't continue to earn more income after we die. So we call that your lifetime capital potential. This tank here that we're showing you is your lifetime capital potential. That's your income tank, okay? As that money flows into your personal economy, it flows in either or quarterly, or however you get paid, however you pay yourself. We typically see income on a monthly basis. Well, the first place that we lose our wealth or transfer our wealth is through taxes, right? We get taxes taken out right off the top, okay? The next place that we lose our wealth or transfer our wealth is through our lifestyle expenses or living expenses. And those can be anything. You know, those types of expenses can be anything from cars, vacations, spending money on your home, going out to eat, college, entertainment, anything you can think of. And so most of our wealth is actually lost through just spending our money. It's that simple, okay? So what we teach clients to do is, instead of going that route, we teach clients to simply store their wealth or store their capital in life insurance accounts. You know, as your money comes into your personal economy through either earned income or other sources, and it flows in there, what we do is we lock down this tax valve, and we don't pay taxes up front. We try and pay taxes at the end of the year, and we use just a little bit of energy and effort and divert that money up into your permanent life insurance account, okay? And what that allows you to do is accumulate all that wealth, or as much wealth as you need, in that account where it's safe and it's liquid, and you always have access to that money, okay? So as this wealth grows in your personal economy and you're diverting it into your insurance account, how do you have liquid use and control over that capital? What if you have to pay the bills? What if you do have these lifestyle expenses that you have to pay for? How do we do that? How does it work? Well, what we do, sorry about that. Let me share my screen again. What we do is we just simply collateralize that life insurance account, borrow against it, and use the life insurance company's money to pay the bills. All right, so any daily living expenses or lifestyle expenses that you incur come from that loan that is being collateralized against your insurance account. All right, the same is true if you have an investment to make. Let's say that an investment comes your way and you have cash built up and you borrow against that account and invest that in whatever investment you want. Okay, now as that investment grows or earns dividends or returns, where do you put that money? That's right. What you do is you just simply put the money back into your life insurance account and pay off that loan. As you pay off that loan, your balance continues to grow and compound, interrupted compound interest, which is huge. We'll go into that next week. The difference between uninterrupted compounding versus interrupting the compounding and what that looks like. Well, once that loan is paid off, you can simply just rinse and repeat and do the whole thing all over again. You know, as new money comes in, or as you sell off that asset, let's say you liquidate that investment and you dump all the money into the life insurance policy, you pay off your loan. When another investment comes around, you just simply collateralize that account again, borrow against it, and use that borrowed money to invest in another deal. Maybe it's a real estate deal. Maybe it's a rental property or a multifamily apartment complex that's earning revenue or income. All right, great investment right now. It's also a great hedge against inflation because we believe that real estate is always going to continue to be more and more expensive. Now, whether the value of the property goes up or down is immaterial, but think about it this way: you got to live somewhere. People have to live somewhere, and so real estate is a good investment. So as you sell off that investment or as you liquidate that property, all you do is simply take the proceeds, put it back into your insurance account, and pay off that loan so that you can do it all over again. Your money continues to grow and compound and earn uninterrupted compound interest. Okay? Now, what if you don't want to use the life insurance company's money for your loans? Well, use this account as collateral. You can still use your life insurance account as collateral and borrow at other rates. This is where your decision making has to come into play. When you see interest rates as low as they are today, if you can get a car loan for 2%, you may want to collateralize your life insurance account and borrow at 2% instead of using the life insurance company's money and collateralizing that account at 4%, for example. I think loan rates at life insurance companies today are at 4.5%, and at banks you can get a loan for 3%, roughly. If you wanted to. If you're borrowing from the insurance company or going to a bank and borrowing from them, it doesn't matter. You can still use your life insurance account as collateral. That's the whole point. Okay. It is 2:39, 2:40 right now. So what I think we're going to do is we're going to respect your time, and we are going to stop here. And next week, what we're going to do is we're going to get into uninterrupted versus interrupted compound interest and what the difference is between the two. Okay. Let me show you real quickly the chart that we're going to look at next week. So next week we're going to analyze what is the difference if you were to save, let's say you were to save money for vacation every year for the family inside an account like this that's growing at 6%, and you were to borrow against that account anytime you wanted to go on vacation with your family, and then just simply save that money again in the account, what is the difference, or what is the cost of spending your money versus saving it in a life insurance account and collateralizing it? Okay, we're going to get into some case studies next week when we talk next. All right, I'm going to stop it right there. And everybody who joined us today, thank you very much for your time. And those of you who are going to be watching later on, give us a call. If you're interested in learning more about how we protect and insulate your own personal economy and your own cash, give us a call. Let us know. Reach out to us. All right. We will we'll talk to you next week, and we're going to go into some case studies of the economics behind this stuff and why life insurance makes so much sense for people. Okay? Have a great day. We'll talk to you next week.